Hi, Bill Beamers here from SEQ Advice. The purpose of this short message is to share with you a video with Dr. Shane Oliver, the Chief Economist of AMP Capital. Shane's very well known for his market commentary and insights from over the years. Now, it is about 10 minutes long, but I do recommend you take the time to watch it. Yeah, so here's our first of more regular updates that we intend to send out to you. And on a regular basis, send you some insights directly from our own SEQ advisors to help you keep things in context with some helpful insights and tips along the way. And as this interview will highlight to you, one of the crucial elements of investment strategy is time, being in markets for the long term, which means really turning down the noise in the short term along the way. And at times like the current, with so much bad news, that's difficult to do. And we're bombarded with negative headlines every day. So enjoy this interview with Dr. Shane Oliver. Thank you.
And you are the expert in this area. So what do you see happening with the economy for the rest of this year? And also interested about the interest rate outlook.
I mean, it's certainly an interesting time and somewhat scary time. I've never been through my career where you've got so many negative news events all at once, you know, from the period of the pandemic onwards. It just seems one after the other now, power prices, interest rates. So it is a somewhat uncertain time. I must admit, I was sort of expecting an aggressive move by the Reserve Bank. We thought it would be 40 basis points or 0.4%, could be 0.5, so we weren't particularly surprised. But that said, the commentary from the Reserve Bank was very what we call hawkish.
Yeah.
They seem to be putting a priority on getting inflation under control, less focus on the economy, so that worries me a little bit. And of course that was reflected to some degree in financial markets in reaction to the move. But I must admit it is an uncertain time because this is the first time in at least the last 30 years, where interest rates have started going up when house prices, on average around Australia, are already coming down, when consumer confidence is already in a bit of a hole, and we've got real wages going backwards. And so all of those things are going to act as a bit of a dampener, and obviously when you throw in higher interest rates to that, it's going to increase the impact on the economy. So I think, yes, the Reserve Bank is right to be raising interest rates. You can't have interest rates down to zero when the economy's been relatively strong, unemployment below 4%, inflation above 5%. But by the same token, I think all of these other factors, the cost of living increase and the fact that real wages are going backwards, that's going to put a brake, I think, on how much the Reserve Bank will actually be able to raise rates by.
Do you see continuous rate rises for the rest of this year?
I think we probably will see another hike in July, and it could well be another 0.5%. Thereafter, I think they're going to slow down. I think the Reserve Bank will want to sit back a little bit and see what its impact has been. If it just keeps going bang, 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 then you're going to get a pile-on. There's often a bit of a lag from a change in interest rates to an impact on the economy. I think at some point in the next few months, they want to pause a little bit and see what the impact's been.
Yeah, tough job there being the RBA governor at this point.
It would be.
Listen, yesterday I spent a bit of time in the car because I was driving back from a conference, and our purpose at AMP is helping people create their tomorrow. There is a lot of pain out there in the community. There's a lot of worry out there in the community, and certainly heard that through the Talkback radio. What's your advice as, you know, part of our investment team for people out there worrying about their investments?
Well, one of the things I like about my job is that I love economics, but I love being able to apply that to investing, so it has a practical application. I'm not sitting around dreaming up economic things. And also it's helping end investors. And in many cases, it's helping keep them on the straight and narrow, because I know there's a temptation to, when you hear bad news, to want to sell. When you hear good news, you want to buy. And so I think the best thing investors can do through this period is sit tight, stick to their long-term investment strategy and see it through. Because one thing we do know is that it's very hard to time investment markets.
I think that's very good advice, right? A lot of people sell when it's going down and buy when it's going up because we can't time it perfectly.
Well, we can't, and even we put a lot of effort into this, and you know, we struggle at times to time it perfectly. I mean, who picked the low in the share markets back in March of 2020? You know, this was the pandemic low. The Aussie share market had fallen 37% from its high a month later, and suddenly it bottomed out, and no one believed it. And of course, a lot of people just stayed on the sidelines, and then of course by the end of the year, 12 months later, the market was all the way back up again. So trying to time markets, I think, is very, very difficult. It does feel very scary out there, what's going on, this constant news flow. I mean, just one of the depressing things about driving into work is that you do turn on the radio.
You do.
And you hear that news flow, whereas if I'm not driving into work, I tend to sort of turn the volume down a little bit. I don't get that negative news flow as much. I mean, you probably experienced the same thing the other day driving back from the Blue Mountains.
Yes, I did.
So you hear all this stuff and it registers in your mind and you feel more and more negative and you think, well, I've got to do something. Whereas often the best trick is not to do anything, stick to the straight and narrow. I guess the other aspect about all of this is that for those with debt, I mean, we've got a lot of customers who have got mortgages and obviously this is a scary time with mortgage rates going up. And obviously, I think the key in all of this is, if possible, try and get your debt down as quick as possible. Use windfall gains or whatever you can to get that debt down. But I think also it's about making sure you've got the right structure in terms of your, whether you've got fixed or variable, whether you've locked yourself into a situation that you can withstand higher interest rates. And hopefully, I think people have sought advice on that and they're well placed to be able to withstand that, notwithstanding the fact that there will be some impact from higher rates coming through.
Unfortunately, the customers over the last years actually have got ahead of their mortgage repayments. So hopefully there's a little bit of buffer there.
That's right.
I mean, I think that's very good advice to pay down your debt, especially your non-tax deductible debt. Always
That's
important
right.
to do that.
Yeah.
But do you take your own advice, Shane?
Well, I do. I can't say that I always did at the start. You start off in this business and you think, well, I'm going to be able to time markets, I'm going to be able to do it. And then you realise, well, that's a lot more difficult. And so when I've gotten into things, I remember buying into the tech stocks in the year 2000. And of course, that was a big lesson for me. I realised that you don't want to get in when everyone else is getting in, when the crowd's piled in, when the things had a long run. You want to try and sit back a little bit. And I guess generally what I've done is taken a sort of more a longer term strategy with my superannuation and my investments outside of super. I wish if I had go back 30 years ago, I took a more aggressive stance in my superannuation. These days, lifestyle funds would probably do that for you when you're younger, but I went into the one-size-fits-all product, which was 70-30, 70% growth, 30% defensive, and I think, oh, maybe I should have had 80% or 90%, but you only realise that a few years down the track, and now it's probably a little bit too far down the track. But outside of super, I also tend to take a buy and hold approach. I have a mix of funds. Actually, through North, I think I'm going to have to update that to my North. Yeah. And a lot of those funds are obviously index funds, but some of them are quite active, mix of Australian and global. And I tend to let them run their course. And I tend to find that if you have a decent mix over time, you will do pretty well.
Let's hope that's good advice. As we look forward to the rest of this year, you've talked about interest rates, we've talked about inflation, and that there's certainly inflationary pressures out there. I drove back, as you said, this week from a conference, and all you look at is the petrol bowser the whole way down to see what the price is. Where do you see economic growth for Australia through the next year and a half?
Well, for the time being, it's pretty strong because we're still having the recovery from the pandemic. A lot of people sensibly built up savings as we went through the pandemic. They couldn't go on the overseas holiday or buy whatever it is they would normally do, and so they built up savings, and many of you used that to pay down their debt. So that's providing a bit of a buffer which will keep us going. So this year we're probably looking at economic growth of around 3.5%. We're probably looking at the unemployment rate remaining pretty low. That said, next year...
Do you see that unemployment rate staying low for a lot longer?
For a while. It's currently 3.9%. It's probably going to get down to 3.5% sometime in the next few months. But we've got to bear in mind that as we go into next year, the impact of higher interest rates, the higher cost of living, those things are going to bear down on growth, and we'll probably see growth slip back down to around 2.5%. So back to much slower growth through next year, at least starting the first part of next year. And that might see the unemployment rate start to drift back up again. But I think providing...
We say drift up again, but we're talking off a really low base.
Off a very low base and staying pretty low. Obviously, there's an uncertainty as immigrants come back, and that injects more people into the labour market. But providing the economy remains fairly strong, which it probably will, then those workers will be absorbed. I think the key for all of this is that the Reserve Bank doesn't get carried away. If you can criticise it at all, you could say, well, 6 months ago it was too complacent. It was talking about rate hikes not occurring until 2024. Now it's getting more hawkish. you just want to make sure that hope that the Reserve Bank doesn't get too hawkish and therefore knock us into recession. But I'm reasonably comfortable that they've got a good handle on things. And yes, they're sounding tough now, but I think they'll pull back before we actually slide into recession. Because you've got to bear in mind, a lot of the factors driving inflation...
You said slide into recession there. What do you suggest?
Before we slide into recession.
Right, great.
So,
I just wanted to clarify.
I don't think we will slide into recession. So I think that's the key in all of this, that central banks around the world, they do face a big challenge, but they also know that a lot of the factors pushing inflation up are things beyond their control, such as, well, in Australia's case, the power situation we currently have, the shortages of goods associated with the pandemic, the recent floods. Now, eventually those things will sort of come back under control, we hope, we would assume, and that will put downwards pressure on inflation, and therefore the Reserve Bank, yes, it has to raise interest rates, but not too far that it causes the economy to go into recession. So that's my base case, that yes, growth will slow down, but recession should be avoided.
Now, I'd like to end on a positive. So that sounds like a very good way to end. So it looks like, yes, there might be slightly higher unemployment, but off a really low base.
That's right.
We could see rising interest rates through the rest of this year, but you believe that will be tapered over time and still economic growth.
That's right.
Thank you.
Thank you. My pleasure.